Rodrigo, before we come back to Keith and Lauren to talk about this theme of productization, um, tell us what made you think about this in a retail solution, and how have you rebranded this concept for a wider audience?
Yeah, I think what had happened is back in 2020, 2021, we were doing okay with institutions, with single family offices. We had some public products where we were trying to ask investors to make room in their portfolios for these alternatives that we were running. And we were just banging our heads against the wall because we had gone through a period where in equities, especially US equities, dominated the return stream of any single asset class, and bonds had done pretty well as well. And so when you're competing for that space, investors are looking at you saying, yeah, no, I get it. You have zero correlation. Yeah, I get it. You have quote unquote alpha, but the S&P's annualized at 10. You're annualizing at 5. There's no way. I'm not going to make room in my portfolio. And at that point, I said, look, we need to yes and this problem, right? We need to find a way to express it. How about you get to keep your 60/40, and we're going to stack that excess alpha on top. We have to rebrand the name. We wrote a paper in 2021 called Return Stacking, Strategies for Overcoming a Low Return Environment. And if you remember, mid 2021, rates were nearly zero. Valuations were the highest they'd been since the bubble. And people were reaching for yield, right? They were going at getting high yield products, private equity, private credit, like levered plays in the same equity. And the solution here was like, how do we reframe? How do we make it more accessible? Nobody knows what portable alpha is. Nobody knows what alpha is. And this is where the idea of renaming an old idea into return stack the retail space, that white paper went viral. And when we started testing that, we realized, okay, this is an important name change, number one. The SEC came out with very clear guidelines for the industry for the first time ever on the proper use of derivatives within ETFs and mutual funds, which then UCITS and Canadian regulatory environment has also started to adopt. And so when we got clear guidelines as to how to use derivatives within ETFs and mutual funds, we were then able to provide a highly professionally run derivatives book, because the reality is prior to that, most mid-sized fund foundations and institutions simply did not have the expertise to have a derivatives desk. And so, as John alluded to, managers like us started creating prepackaged solutions. And really that helps I'm just going to share my screen real quick. That helps in the funding problem. Can you guys see my screen? What this shows is a wide variety of alpha strategies over that 20-year period. And what you'll note is that none of them do better than 10%, which is what the S&P did during that period, right? So this concept of, hey, your alternatives should be in this thing that's going to make you less, which just wasn't palatable. And that's why everybody went private equity, because you could get better returns because you were leaving beta, right? So what portable alpha does is it solves the funding problem, right? We were seeing people for probably all of our careers in the alternative space, we've been saying to people, look, make 20% of room in your portfolio, sell 10% of your bonds, sell 10% of your equities, and make this 20%. And over that 2-decade period, 20% has grossly underperformed the 60/40. Nobody wanted that, right? The benefit of portable alpha is that it solves the funding problem, allowing investors to use, to keep their favorite toys while stacking that excess return on top. And of course, we've talked about what's important. So in essence, what ends up happening is any return of those alternative strategies above cash, it may be 200 basis points, 400 basis points, 600 basis points that used to be super unpalatable, all of a sudden become Lego blocks that you get to stack on top. When you add it up, you end up providing investors with a different way to outperform a benchmark, right? And you could choose your stacks. This is the beautiful thing about portable alpha. A lot of people investing, we like to think it's a one-stop shop. There's a lot of values invested in what you believe in. Do you believe in trend following? Do you believe in carry strategies? I believe gold and systematic macro, market neutral. Every client's going to have a different view. And so the goal here is to democratize and provide people the Lego blocks so that they can make their own decisions as to what to stack on top, and that prepackaged solution being managed, right? So I think the language has changed. I think accessibility, the clarity from the regulators, and then the simple story of like, what do you have more confidence in the future? Do you have more confidence in finding a active security selection manager that's going to outperform a benchmark. By the way, this 1.17 is what the outperformance has been of the top decile managers in the last 10 years, right? And the chances that you're going to be able to capture this in the next 10 years by buying the same manager is probably a rough thing. Or do you have confidence in a bunch of diversified alpha streams that you can stack on top? And I would say that the latter argument is winning the day. And now individuals are talking about it. They're on Reddit. They're getting it. So it's been pretty exciting to watch. And I think it probably is going to warrant a completely new category in Morningstar and whatnot, so that those prepackaged managers, which there are a lot of, will start being able to source them and provide better portfolio construction in the future.
That's fascinating. Thank you so much for that and for the visual as well.